What happened yesterday?
Well, to be honest, I don't think yesterday was really a macro story. You didn't have a huge amounts of macro news. Inflation expectations didn't really shift. I think it was largely off the back of Apple suppliers coming out and saying they thought they would have to order fewer iPhones. But like you said, retail also got hit. So that could be questioning how much the tax bill is really supporting retail sales, how much consumers are buoyed by it. This late in the game, most of the tax bill probably benefited the consumer in the first 3 quarters of the year. And that's just going to peter out from here.
As you said, there was no particular macro event yesterday, but is there a macro background noise that the markets are really skittish about? And does it have to do actually with withdrawal of quantitative easing?
Yeah, so that could be part of it, although I'm not sure anybody's really trading on that. That's a real slow burner. So as global liquidity is falling generally, that's showing a whole bunch of imbalances in our economy and others. And between our economy and others as well. So it's a bit like, the tide going out and seeing who's swimming naked. But I don't think anybody's really trading off the back of that. I'd also suggest, trade is a constant drum in the back for everyone. But I'm not sure anybody's really trading on that. I've been really surprised by how little the markets have been moved by things like trade. And part of that could be that on an average day, 90% of equity trades are done by passive funds. So that could be partly why.
So before we get to trade, just want to go back to the Fed for a second. So there's 2 schools of thought. I mean, one is that you have higher real rates and the market's called a terminal rate at 2% and then they start to freak out. On the other hand, you have JP Morgan saying you want to buy U.S. equities because the curve is consistent with the rally in the S&P over the next 12 months. Real rates aren't that high. Which is the right narrative?
Well, so I think that this recovery will last a while longer, and that might be underappreciated by the markets because there's this consensus view that a recession is coming in 2020. Let me tell you, when economists have a consensus view for when a recession will hit, it almost certainly won't hit then. So I think it could be pushed out a bit further, actually, even with a split House and Senate, because, I think they could agree on some kind of infrastructure spending bill. And if noises start coming that they're working towards that, then I think the markets might reprice. The recession could be pushed out a little bit just because of a sugar hit, not because anything's fundamentally different. And the markets could have some room to run.